What do you think is the biggest risk to the economy right now that no one's talking about?
It's that credit. That's it.
So explain this like I'm 5.
Because Jack is 5.
Yes.
Basically.
Explain it like to Jack.
A lot of debt that, so people owing other people money, and we don't know if those people are going to be around in the next 5 or 10 years, whether those are data centers, people who are building out, H100 NVIDIA facilities or data centers, or they are construction companies that are building these and rapidly expanding their debt so they can hire people to build out, whether they're, generator selling companies, whether it's, not Generac, but there are plenty of other even private companies that are trying to build out data centers, and everybody's trying to expand quickly. So people are taking on debt to facilitate data center construction. Somewhere that's all going to go to crap one day when that cycle turns.
So how are you so sure of that?
I'm not. That's the toughest part, is I don't know where the credit cycle will be. I think it'll be in data centers, but it could be in somewhere else. Somewhere.
So what you're assuming probably will happen, because we will always need data centers, but there will be a few winners, a lot of losers, and these losers are going to be caught up in the credit cycle?
Well, it's typically what happens when you have an industrial boom is we overbuild. So there were like a quick comparison. If you go back to like the .com bubble, we always think of like the consumer.com bubble, like pets.com or whatever. But before that, you had the infrastructure build out boom, dark fiber, basically. Let's lay fiber everywhere we can. I think there was a company called WorldCom and Cross Country, I don't know, whatever. Massive debt expenditures driven by spending from the big mega cap incumbents of the day, which is exactly what's happening today. Except just for scope comparison, back then, the total, the highest annual CapEx spend was $82 billion from all of the mega cap incumbents back then. Today, NVIDIA almost makes $80 billion in a quarter. In about 100 days, NVIDIA makes about $80 billion. The top 5 data center plays, so like Google, Meta, Oracle, Microsoft, and Amazon, are projected to spend over $1 trillion in CapEx next year, which is more than 10 times what we saw in the dot-com bubble. And I think a lot of that is financed by debt. There's a reason why companies who are doing great, Google's great. There's a reason why, though, Google and Meta have stopped doing stock buybacks. If you go look at their earnings, they're like, oh, last year you guys were buying back all your stock. They do that because they issue a lot of stock comp to their people. And the people who work there are like, well, I want to buy a house or a boat. I'm going to sell some stock. So the company buys back the stock so it doesn't impact the stock price and the CEOs get yelled at or fired because the stock goes down. So they buy back stock. They've stopped doing that because they're out of money, which is crazy. If you look at Microsoft's balance sheet, it's like, what'd you guys do with all your money? It's all gone. It's crazy. The balance sheets have gone from amazing to bad. And Meta is now hiding debt from their balance sheet. They're literally able to structure, somehow legally, $27 billion lease commitments that don't show up on their balance sheets. That was a Blue Owl deal that they just did last year. Doesn't show up on their balance sheet. So a new investor who goes in says, I'm going to be a diligent investor. I'm going to look at the balance sheet. $27 billion wouldn't even show up. So you wouldn't even know, which is scary. So I don't know where it all comes out. I don't know when it's all going to collapse, but it's going to be an overbuild. It's all going to collapse. It's going to be ugly. And a lot of people are going to get really hurt, and leveraged ETFs are going to go to zero.
I was reading, though, that a lot of those aren't really going to impact the broader market. That if you're in the S&P 500, you're going to have very little to worry about outside of a few deals that seem to be isolated.
That's the hope. The biggest thing that concerns me about the economy outside of credit is the labor market. The labor market drives everything. There's a reason why retail sales are still booming right now, which is crazy that they are, but they just keep beating estimates. Even with oil prices, 50%? Well, actually, we're almost double the oil prices per barrel that we had in January, which is also crazy. But despite that, people are still spending more than economists have been expecting. And that's even excluding oil and gas.
All driven by the top 1%. Predominantly.
Yeah, okay.
Maybe 80% of that spending is like the 1% because the stock market is so high. And it's an annoyance to go and fill up your gas tank and pay $7, but you don't care.
This is true. There is a massive, massive wealth effect. People are feeling rich because the stock market is at all-time highs. And so that'll actually bring me to my point. And you're right. Yeah, the top, 1% has a big spending, top 10% has a big spending, top half spends almost all of it, right? The bottom half doesn't matter so much for spending, which is sad. But the point is, that's what drives the economy. The consumer is still 72% of the economy. That'll start flipping because of AI. But what's really interesting is when people lose their jobs, then they stop spending. And so that's what makes me the most scared, is that once we see that slowdown, we don't know when it's going to be, but once we get that construction build out slow, all these great jobs reports we're getting, they're not going to have that support anymore from construction or from, software developers getting hired. Ironically, even in the age of AI, we're seeing more software developers get hired now.
And here's my prediction. The stock market's going to keep going higher and higher and higher and higher. And people are going to keep saying it's a bubble, it's a bubble, it's a bubble. And then there's going to be a point where they're going to say, I was wrong. It's not a bubble. And they're going to buy.
And that's when you sell.
And that's the moment you got to click sell, is when all the doubters say, I can't keep doing this any longer. Yeah. I'm back in.
But they'll never do that.
They will.
Michael Burry will. I just don't think that.
I think there will get to a point where the majority of people out there who've been sitting on cash say, "Fuck, I've lost so much in opportunity cost. I've been wrong. I'm going to buy it."
So what do you think then for the average person? Because this is one of Graham's favorite things.
Yes,
is having what we call dry powder.
Oh, yeah.
So having a good amount of cash. Like you said, your portfolio is what, 15% cash, 20% cash.
Well, it's not cash. It's treasuries.
Yeah, cash. So he has 20% cash, treasuries.
A stabilized asset.
Cash equivalents.
There you go. Do you think that this is a reasonable approach for most people? Like what percentage cash or dry powder, treasuries, cash equivalents, should they have set on the side to purchase in the case something happens? Like we have another like geopolitical crash.
I think that's great. I'm a big fan. I think a lot of people could benefit from that, because what it means is, first of all, if you have cash on the sidelines, you probably don't have a lot of margin. It depends on what kind of structuring or deals you're getting, but margin rates for most people are very high right now. And so if you have cash on the side, there's a good chance you're not borrowing against your stock, in which case you don't have pressure to sell. And if the market goes down, the market goes down. It doesn't matter. You have that opportunity to buy. And psychologically, when people are buying when the market's going down, it kills that feeling of fear of, oh crap, it's going down. I'm losing all this money. You're buying. If you're buying, you're psychologically seeing it as an opportunity, which is great because you're increasing your ownership. Like I always see it as ownership. With any stock, if you if you have a favorite company or you want NVIDIA, the stock price is at 150 during the geopolitical crisis. Great. I was able to buy more ownership of that company at a lower price. It's great. DCAN.
So then how is your net worth divided up? What does your portfolio look like in the middle of 2026?
Well, there's a good amount of treasuries, cash equivalents. Love that. Really big fan of that right now.
What percentage cash equivalent?
A lot of my net worth is in house hack, in reinvest. And I don't really know what the daily value of that is because it's a private company. There's one value based on what we recently raised at. Then there's a value based on what we're about to raise at, probably in like September. And then there are also stock options. So that's a big skew. But let me put it in comparison to history. In comparison to history, I've got probably 4 times as much cash than I've ever had before now. And I feel great about it. No debt too, which feels great. So I think that's probably the easiest comparison.
There was a viral clip from our podcast that occurred recently of Kevin O'Leary saying you're not truly wealthy until you have $5 million of cash liquid available to you at any given moment. Yeah. What do you think about that?
Yeah, I think that's great because now you're sitting around with true like just FU money basically. It doesn't really matter if the car needs a $10,000 repair or the house needs a new roof or whatever. If you've got 5 in cash sitting around, those are all just rounding errors, right? That's a wonderful place to live in, but that's not for everybody, right? Kevin O'Leary's talking about the top 1% or maybe even a fraction within the top 1%. So it's not relatable. And so honestly, I haven't seen the clip, but he probably gets a lot of flack for that. But that's kind of what keeps Kevin O'Leary really relevant because he says these things that people go crazy over. Yeah. He's really good at clips. I think that's why like Fox loves having him on. The clip man.
A lot of people actually agreed with him. Like if you went into the responses, a lot of like wealthy people are like, I actually 100% agree with this.
Totally.
Which I was blown away by. I thought he was going to get a lot of hate for saying
I honestly thought he was going to get hate too, but I also agreed with him. So that's interesting.
If you have a cat, you know that keeping them healthy is a non-negotiable. And a big part of that really just comes down to diet. By choosing a quality cat food, you're buying more time with your cat and giving them a happier, healthier life.
That's exactly why we are so excited to partner with Smalls. Smalls is fresh, human-grade cat food that does so much more than just feed your cat. It helps them live a full, healthy life.
Not only is Smalls healthier for your cat, but it also noticeably improves their energy. In fact, 88% of cat parents say that after feeding Smalls, their cat is softer and shinier and has more energy to play.
Smalls recipes are over 80% protein, which helps your cat build the muscle they need, and they never use fillers or artificial ingredients.
Personally, I found that finding the right cat food is really difficult because in my case, I have one cat that will literally eat anything. Like you leave any morsel of food on the table, it just will eat it. The other cat's extremely picky, but with Smalls, they both enjoy it. It's the perfect fix.
If you're ready to find your forever cat food, Smalls is perfect for you, and for a limited time, because you're a Nice Coffee Hour listener, you get 60% off your first order plus free shipping and free treats for life when you head to smalls.com/iced. That's 60% off your first order plus free shipping and free treats for life when you head to smalls.com/iced.
Thank you again to Smalls for sponsoring this podcast.